In this example video, we're going to be looking at review exercises 13-3 and 13-4. So it tells us on July 1st, 2019, Wolfpack Corporation purchased securities, which it intends to buy and sell frequently. These securities consist of Todd Corporation 10% 5-year bonds with a face value of $20,000, which were purchased for $18,500. And they want us to prepare the July 1st journal entry to record the purchase of what we call these trading securities. In order to have any investments classified as trading securities, it has to be something that the company plans to trade often. So this really only happens for businesses such as banks, mutual fund companies that do this for a living. They're buying and selling investments very frequently. And those investments can either be debt investments, meaning that they're purchasing bonds, or they can be equity investments, meaning they're buying shares of stock in another business. But again, the key thing is they intend to buy and sell them frequently. They're not holding them until they mature. And typically it's going to be a company whose business is around actually buying and selling investments. So we're going to record this journal entry on July 1st. We have an investment in our trading securities. And again, we always record everything at what we've paid for it. So we paid $18,500 and we've paid cash of that $18,500. In review exercise 13-4, it says, referring to the information above, assume that on December 31st, the company received interest on those Todd Corporation bonds. They use the straight line method to amortize any premiums or discounts. And we need to prepare the December 31st journal entry to record the receipt of that interest. So on December 31st, what we are going to be receiving is cash. So in order to calculate our calculation, we always go at the face value of those investments, which in this case were $20,000, times the annual interest rate, which was 10%. And we have to cut it in half because it's 6 months since we've actually purchased that investment. So we can only do that from July 1st to December 31st. We are only the investment holder or the bond holder during that period of time. So we can't do an entire year's worth of interest or cash that we're receiving. So we're going to receive $1,000 in cash. They told us that we use the straight line method in order to amortize any discount or premium. So the face value of these investments were $20,000, but we only paid $18,500. So we actually got these investments at a discount. So what that means is that every time we record an interest payment, we have to increase the carrying value of that investment. We have to keep bringing it up. So if by chance we hold on to those investments until their maturity date, that value of our investment would equal the face value of those investments. So we're going to increase our investment in trading securities. So we had a $1,500 discount that we had, so the difference between the $20,000 face value and the $18,500 that we paid. And we're going to divide it by how many semi-annual interest payments we plan to make, or receive rather, and that's going to be 10. So we have our 10 semi-annual periods. So that means we are going to increase our investment account by $150 every time we record an interest payment. And we then credit our interest income for the sum of the two. Basically, what's going to happen is when we actually receive that $20,000 face value, if in fact we hold on to that trading security until it matures, we could sell it before then because this is a trading security. But if we held on to it, that extra $1,500 is basically seen as an additional interest payment that is being made to us. So that's why we're recording more in interest income than we're actually receiving with every interest